welcome back to UNC Video channel. If you are new, welcome. If you are not, welcome back. Today, this topic that I'm going to share with is very relevant to every property buyer because 95% of us, when we buy property, we would definitely take up loan, right? A mortgage loan. So usually when you take up a mortgage loan, one of the very important things that I always advise my clients to do is always take up an insurance against the loan that we take up with the bank. So this is part of risk management. If let's say we need to meet up with our maker earlier than we expected, right? We always want to leave an assets to our loved one instead of a debt. So in order to do that, whenever we buy any property, each and every one of the property for myself, I would always take up an insurance against the loan. In the event if I need to meet up with my maker earlier, all this outstanding mortgage which has not been paid would have been taken care of by the insurance which I bought. Now come the questions. My client would usually ask me, should I take MRTA or should I take MLTA, and what's the difference? Okay, so today, briefly in layman term, I'm going to share with everyone what's the difference between MRTA and MLTA. MRTA, if you were to Google, it actually stands for Mortgage Reducing Term Assurance. Means that the coverage that we take using MRTA, it would actually reduce according to the years, just like how our mortgage loan outstanding would also reduce as we pay down over the years. Whereas MLTA, it actually stands for Mortgage Level Term Assurance, which means that the insured amount would always remain the same. If today you were to take up an MLTA for 500,000 for let's say 30 years, for the next 30 years, the coverage will remain at 500,000. It will not reduce, as opposed to if you were to take an MRTA for 500,000, the coverage would gradually reduce as the years goes by. So definitely you would ask, so why don't I just take an MRTA? Because as we pay down our loan outstanding, the loan would also be going down, so the coverage for MRTA should be sufficient, right? Yes, but that's the tricky part, is that when we sign up for our loan, usually we sign up for about 30 years or 35 years. So the interest rate that we sign during that point of time would actually changes according to the changes in our OPR. So in recent months, in fact, our Bank Negara has actually reduced the OPR. When OPR is being reduced, I think it's pretty fine, because means that the total loan amount would have been reduced due to the lower or cheaper financing cost. But what if the OPR has been increased after we have taken up the loan? Okay, just like now, if we were to take up a new loan for the next 30 years, the OPR is now at one of the historical low. So we have to be prepared that reasonably within the span of 3 to 5 years, there will be a hike in OPR, means adjustment in the interest rate, and eventually during that period, our interest rate would actually go up and our total interest cost would actually go up as well. So in that case, the MRTA that we bought now will not be sufficient to cover the full outstanding sufficiently due to an increase in the interest, right? So usually there would be a difference of a percentage of maybe 5 to 10%. So if you were to take out MRTA in that situation, in the event of untimely pass away, then the MRTA that is being paid out to cover your loan outstanding, there may be a little bit of shortfall, maybe 5 to 10%. So that's the reason why some other buyer might think that they don't feel good enough because the coverage is not 100% covered. So they would opt for MLTA, where the coverage will always be 500k without reducing over time. But the difference is MRTA, you only pay the premium one lump sum, and the premium is usually way cheaper compared to if you were to pay for MLTA. Usually for MLTA, the premium you would pay like in a span of 10 years time or 20 years time instead of one time off payment. So in total, the premium that you would have paid for MLTA would have been way higher than MRTA. Okay, and MRTA usually you can lump the premium into your loan as well. Okay, but MLTA you can't. Okay, so MLTA you have to fork out, just like when you buy another insurance policy for yourself. Okay, and another plus point with MLTA is it comes with a savings value. MRTA purely offers you insurance coverage and on a reducing basis. MLTA will offer you a level insurance coverage without reducing over the years, and at the end of the tenure you will also receive a savings amount. Usually the savings amount, there will be a projection of in good performance, the highest performance, how much you can project to get, or the worst performance, how much you will get. Usually the agent would show you in between. Okay, take the in between projection as in combine the highest projection cash value and the worst performing cash value, and you combine both together, divide to 2, that will be the average cash savings that you would get at the end of the tenure of maybe 20 years later, you know. So if you were to ask me, so even you have been buying so many properties, so do you take a MLTA for every one of your properties? The answer for myself personally, no. For myself personally, I prefer to have MRTA for each of the property that I buy. Why? Because as and when I sell off this property, I will just cancel off this MRTA if there is remaining value in it. Whereas if it's an MLTA, I can actually pay, and then when I sell off one, I can actually use this MLTA to cover for my other properties. But for myself, like I buy and sell properties, and currently I'm holding more than 10 properties. If I were to take out one MLTA for each of my properties, I think the premium that I have to fork out every year or monthly will be quite a lot, as compared to if I were to just buy an MRTA for each of my property loan, that the cost will be way lower. So to me, I look at it whenever I buy insurance, it's purely for insurance coverage. I don't look at the savings value. But if you are someone who would want to look at buying insurance to get protection, and on top of that you would like to get back your savings value, then you can opt for MLTA. But MLTA will not be so practical if you know that you are going to buy 5 to 10 properties, because the premium combined, if you were to continue to hold on to these 5 properties or 10 properties without selling it off, you would need to still have insurance coverage for each of your loan. Then if you were to take up 10 MLTA for 10 of your mortgage loan, it's going to cost you a lot. Okay, unless you know that you're only going to buy 1 or 2 properties and you only need 1 to 2 insurance protections against your mortgage loan, then I think it's okay to get MLTA in order to get the 100% level insured amount, and also get back your savings value at the end of the tenure, as compared to if you were to just buy MRTA to purely cover you with the protection on the reducing basis, and then you might even encounter there will be some insufficient coverage in the event of payout if there is a hike in OPR during the whole period. So some of my clients would ask me, so even you take up MRTA for each and every one of your mortgage loan, okay, what if in the event there is a shortfall in the coverage due to a hike in OPR, a hike in the interest rate during the period you're holding on to this loan? I said it's okay for me, because on top of that, I still buy another term insurance, which is just to cover whatever shortfall that I have, because I told you I have got more than 10 properties. So I will actually buy another MLTA, but it's under term assurance, and the premium will also be lowest, but it offers the highest protection value for me. So that's it. I hope I make this topic clear. That means if today you know that you're going to buy only 1 to 2 properties and you like to get 100% insurance protection and also get back your cash value at the end of the insurance period, go and get MLTA, which is just like another insurance policy. Okay. But if you know that you are going to buy more than 5 to 10 properties and you'll be holding all these 10 properties concurrently, there's no way you can buy 10 MLTA to cover for each and every one of your mortgage loan. That's when you would opt for MRTA, where you only need to pay the premium one time off, and you can even lump it together into your loan, and it will offers you a reducing basis coverage. If you have concern that there will be shortfall that you want it to be covered, you can separately take up another insurance policy on a term basis, where it also offers you the highest coverage but at the lowest premium. Okay, and at the same time also without any savings. So like what I said, whenever I take up insurance, it's purely for protection. My top priority is for protection, not so much for getting back cash or savings. Okay, that's it. So remember to subscribe to my channel if you want to stay updated with the latest Malaysia's property news and also property trend. And also, I would also cover new property launches, new project launches, especially in Penang and mainland area. So that's all, guys. If you like my sharing today, do give me a thumbs up, share and subscribe to my channel so that you will not miss out on any of my latest video upload. Okay, that's it. Bye.